Hi, this is James Zhang, and today we're talking about cap rate. So, what is it? How's it used? Why does it matter? So, cap rate equals NOI divided by purchase price. And so, NOI equals net operating income. Net operating income equals revenue minus expenses. So, let's go from the example of a buyer. Let's say there's a property, NOI is $500,000, and you buy it for $10 million. So, that is a cap rate of 5%. But let's say you go back to the seller and you negotiate and you're able to get it for $8 million. So now all of a sudden that cap rate is 6.25%, right? So you're able to get a lower purchase price based on that cap rate. Maybe there wasn't a lot of buyers at that time for whatever reason, and they were able to accept a lower price. So the cap rate is influenced by your location. So the market, the submarket that you're in, the quality of the property. So when it was built and what assets does it have, such as is it individual HVAC? Does it have washer dry connections? Does it have granite in all the units? The tenancy, right? So is it higher quality tenancy? Um, and then as an investor, you don't control this market rate, right? So as a cap rate, it is based on what investors are willing to pay for that property. And so on the right hand side, you can see this comes out of an appraisal that was done recently. They look at a couple things, right? So they look at comparable sales, they look at surveys out there in the market. They call listing brokers, they call other buyers, other participants in the market, and then come up with a cap rate. So on this deal, it's a Class B deal for five. They assigned a 5.5% cap rate, and they also looked at on the below right hand side, they also looked at comparable sales, right? So anywhere from the last probably 12 months or so when this appraisal was done, and the cap rates range from 5% all the way up to 5.5%. So this is we talked about what drives cap rates, and depending on the market that you're in, whether it's preferred, primary, secondary, tertiary. Preferred being sort of your top markets: New York, DC, Boston, LA, things like that. Those range from anywhere from 6% and dropped all the way down to probably 4% in the last couple of years. And your tertiary markets are the things that are outside the big city, and those range from anywhere from 8% and got down probably all the way to 6% in the last couple of years. And so you can see the spread, in the recessions like '09, 10, 11, that spread got up to almost 400 basis points, when in comparison to now, it's probably closer to 200 basis points as people went out to those markets to get yield. And so depending on the market, depending on the submarket, I mean, this can almost be translated into a market, right? So if you, let's say within Dallas, this is, there's submarkets that are, more preferred over others, and that's going to drive a lower cap rate. And so here in Dallas, we talked about the where the market is, but then also the quality of the building, right? So cap rates on older properties, let's say built in the '60s with flat roof, chiller property, a lower income demographic, their cap rates were almost double digit in Dallas, and it has come all the way back down to probably that 6 to 7% range. Your Class B deals are more like the stuff built in the '80s or '90s, and those rates were probably 8% all the way came down to close to 5.5%. And then your A properties, they were already 6% and then came down to probably 4.5%. And so your A properties are your nicer properties developed in the last probably 10 years or so. So why does this matter, right? So when you're buying, you want to buy at the highest cap rate possible, right? Get the highest return possible. But when you're selling, you want to sell at the lowest cap rate possible. And so cap rates are a significant driver of the value of your property. And so let's just take the example of, let's say you bought that property for $10 million at a 5% cap rate. You drive the NOI to 600,000 over 5 years. And now you're able to sell, let's say at the same cap rate, 5%. The property is now worth $12 million. So you made $2 million on really that NOI growth because the cap rates didn't move. But a lot of people, let's say they bought in 2014, 2015, and they bought a deal, let's say 500,000 NOI at 7% cap rate, and they paid essentially just a little bit more than $7 million. And then, 3 or 4 years later, cap rates in that, let's say C class property compress. And then all of a sudden, you sell it for a 6% cap rate, and you didn't do anything on the NOI. then you could sell it for $8.3 million. But if you did increase the NOI, then all of a sudden it's worth $10 million. So you can see that, depending on how much cap rates compress, a lot of the value change can be driven by NOI, and a lot of it can be cap rate. And so, um, in the past 3 or 4 years, a lot of people have made money just purely on cap rate compression. But going forward, I don't know if cap rates are going to continue to compress from where they are. But here's a chart that's pretty interesting. And, this is, cap rates are driven, by investors' interest, right? And so if investors are looking at what other properties they can buy, what other things they can invest in, one of the things that they typically look at is the 10-year treasury. And so 10-year treasury right now is under 1%, so 0.7, and multifamily cap rate across the nation is close to 5.5%. So there's a 477 basis point difference between those two. And, if you're going back all the way to 2006, 2007, the spread between those two got under 200 basis points, maybe down to 150 basis points. And that was the tightest it was ever. So when it gets into that range, people get very nervous. But since interest rates are so low, a lot of people are thinking these cap rates are going to sort of stay at the same level that they are right now. So my background was really around loan underwriting and originating loans. So if you have any questions about commercial real estate transactions or investing in properties, here's my email and phone number. And if you like this video, like the video, subscribe to the YouTube channel and complete your personal financial statement to set up some time to talk with me, whether buying, selling, refinancing your next multifamily deal. Thanks a lot.